Welcome back to the Deep Dive, where we take your source material, the dense research reports, the surprising financial footnotes, and cut right to the core of what matters. Today, we are diving into a strategic metamorphosis so dramatic it's almost unbelievable. We are analyzing the Ball Corporation, known by its ticker BALL.
Right.
This is a company that has spent decades achieving genuine high-tech prestige, helping put critical optics and components into orbit for projects like the Hubble.
And the James Webb Space Telescopes. We're talking top-tier stuff.
Exactly. And at the same time, they're the company putting beer and soda into aluminum cans.
It's the ultimate business identity crisis. I mean, for years, investors looked at Ball and asked, are you a defense contractor or are you a bottling company?
Let's hear a question.
It's a question of capital allocation, evaluation, and frankly, of corporate soul. The core question we have to answer for you, the listener, is fundamental. Why, after decades of technological glory and government contracts, did Ball bet the entire farm on the humble aluminum can?
Why did they choose cans over Cosmos? Okay, let's unpack this. Our sources today are deep, dense investment analyses detailing what Wall Street calls a structural re-rating. That's a fancy way of saying the market has fundamentally changed how it views this company, moving it from a confused, diversified conglomerate.
Which almost always trades at a discount.
Right, a conglomerate discount. And moving it toward a focused, pure-play leader that, deserves a premium valuation.
And that re-rating hinges on three foundational pillars, which really, they form our deep dive mission for today.
Okay, what are they?
First, we need to understand the strategic logic behind the massive $5.6 billion sale of their prized aerospace division. This was a defining existential move.
Second, and we have to dissect the powerful secular shift toward sustainable packaging. This isn't a fad. Our sources are calling this a multi-decade volume runway.
A runway, yeah. Meaning the demand for aluminum packaging is pretty much locked in for years to come, driven by consumer guilt and, more importantly, by regulation.
And third?
And third, and arguably the most critical for long-term shareholder value, we need to understand the rigorous financial discipline at the core of Ball, this EVA culture.
EV.
We'll examine the mechanics of their economic value-added approach and why, despite having this massive market tailwind, the company is, kind of surprisingly, currently struggling with a core profitability metric.
So this is about more than just cans.
Oh, much more. This deep dive is about the economics of industrial compounding, geopolitics, the mechanics of oligopoly pricing, and the constant, relentless battle for capital efficiency.
Let's get started.
To appreciate the scale of this 2024 divorce, you really need to understand the depth of Ball's historical DNA. I mean, adaptability and reinvention.
Right.
They aren't just corporate slogans here, they're the historical reality.
Absolutely. The company's history reads like a timeline of American industrial evolution. They were founded way, way back in 1880.
A long time.
Starting with wood-jacketed tin cans for industrial goods. Then came their most iconic product, the glass fruit jar, the classic Ball jar that, still graces kitchens today.
Everyone knows that jar.
That brand built their legacy. But in the 1990s, they realized glass was slowing down, and they made the painful but very prescient pivot almost entirely toward metal packaging.
And almost bizarrely, running right alongside that packaging business, we had the aerospace anomaly.
The anomaly, I like that.
That division was created way back in 1956 to support research for the nascent space program. And for decades, it provided immense technological prestige. We're talking about highly complex, high-precision engineering.
Building sophisticated components, optics for the very best of NASA's deep space missions.
Exactly. Hubble, Webb, the big ones.
But, technological prestige doesn't always translate into clean shareholder value. The capital cycles for aerospace are just completely different from packaging.
Not even in the same universe.
If you're bidding on a 10-year, multi-billion-dollar government contract to build a satellite, your revenue is lumpy, your talent requirements are highly specialized, and your capital allocation is, well, it's erratic.
It simply did not mesh with a global manufacturing operation that churns out over 100 billion beverage cans annually on these massive continuous production lines.
The synergy was basically zero.
The sources confirm that the synergy between satellites and six-packs was non-existent. The identity crisis created what analysts call the conglomerate discount.
Right.
Investors simply weren't willing to pay a premium for either side of the business because they were constantly trying to value two fundamentally different businesses operating under one roof.
So the sale was the only way out.
The $5.6 billion sale of Ball Aerospace to BAE Systems in early 2024 was the definitive, painful, yet absolutely necessary resolution of that crisis.
It ended the discount.
It ended the discount, and it immediately clarified Ball's investment thesis for everyone. From that day forward, they are a pure-play packaging company, period.
So they successfully engineered the biggest divestiture in the company's history. They now had $5.6 billion in cash, which is a massive war chest.
A huge amount of capital.
And they didn't use it to immediately go out and build a dozen new can plants. Our sources note the proceeds were deployed with strategic precision. What did that deployment look like?
It was a very deliberate, very focused move. Two core areas: immediate balance sheet repair and aggressive shareholder yield.
Okay, let's start with the balance sheet.
First, they prioritized debt reduction, which is absolutely vital in a capital-intensive industry like this. They were aiming to reduce their net leverage ratio, that's net debt to EBITDA, down to the 2.5 times range.
And why is that number so important?
Achieving that lower leverage is critical. It gives them immense financial flexibility that their heavily leveraged competitors, as we'll see later, simply do not possess. It's a strategic weapon.
Okay, so that's part one. Part two was shareholder yield. You mentioned the share repurchase program. This is where we see the concept of the cannibal strategy, right? A term often reserved for the highest quality industrial compounders.
Exactly. This is so much more sophisticated than a simple stock buyback designed to just, juice a quarter's EPS.
It's a long-term play.
It's a compounding mechanism. When management believes the stock is trading below its true intrinsic value, which they clearly did, given that lingering conglomerate discount, aggressively retiring equity is one of the best things they can do.
How does that work exactly?
By shrinking the denominator, the number of shares outstanding, they ensure that all future earnings growth is accelerated on a per-share basis. It's a powerful floor for the stock price and a continuous, very tax-efficient way to return capital to the remaining owners.
Yeah, this isn't just theory either. We see it in the numbers.
The numbers are huge.
They returned $1.27 billion to shareholders in the first 9 months of 2025 alone through buybacks and dividends. And management is forecasting another $1.5 billion for 2026.
That is an enormous amount of capital being retired. It shows just deep conviction in their new focused future. They're betting on themselves.
So they're optimizing the capital structure to the highest degree.
Completely. They clean the slate, they reduce debt to a conservative level, and now they are using all that excess cash to create maximum long-term value for the people who still own the company.
But this strategic pivot, this big change, it required a change in leadership to see it through.
It did, yes. The CEO transition happened abruptly in late 2025. Daniel Fisher, the architect who orchestrated this massive divestiture, was replaced by Ron Lewis.
And Lewis had been the chief supply chain and operations officer. What does that abrupt change signal to the market?
It signals a fundamental shift in the board's mandate. Fisher was the deal maker, the visionary who executed the transformation. Once that transformation was complete, well, the board needed a different skill set.
A mission change.
The mission change. They signal a pivot from empire building, from deal making and structural change to pure, unadulterated execution and efficiency.
So Lewis's background suggests his marching orders are singular, operational excellence.
Precisely. His mandate is to sweat the assets hard. It's about squeezing every possible ounce of yield, of margin, of efficiency from the existing global manufacturing footprint.
No more big deals.
It means relentless focus on lowering conversion costs, optimizing logistics, and ensuring that those billions of dollars of invested capital are actually generating their cost of capital, which, as we'll get into in part 3, is the single biggest challenge he faces. The board wants a proven operator, not another deal maker.
And the decision to deconsolidate the loss-making aluminum cup business is another perfect illustration of this new cold-blooded financial discipline under the new regime.
It is the absolute embodiment of the new mandate. The Ball aluminum cup was a bold, visible innovation, a product for stadiums, for mass events.
I've seen them.
But it was consistently failing to scale. It was racking up losses of approximately $40 million annually as a standalone unit.
That's a huge drag.
It's a persistent drag on the consolidated margins, and it directly undermines that efficiency narrative they're trying to build.
So they didn't kill it outright, they just moved it off the balance sheet.
Exactly. They deconsolidated the business into something called Oasis Venture Holdings by selling a 51% stake to a partner, Iana.ai. This achieves two things at once.
Okay.
First, They immediately move the current losses off Ball's P&L, eliminating the margin drag. Poof, it's gone. Second, they capped their downside risk while retaining a 49% equity optionality.
So they still have skin in the game.
If Ina.ai, which specializes in digital marketing and rapid scaling, can succeed where Ball's traditional B2B sales force struggled, Ball still benefits significantly from the upside. It's highly disciplined capital management.
Cut your losses without sacrificing the innovation entirely.
That's the playbook.
We've established they are clean financially and focused strategically. But that pristine balance sheet and ruthless efficiency, that's just the structure. The core question is, what is the market they are fighting in?
Right.
If this were a fragmented, low-margin business, the whole strategic pivot wouldn't make a lot of sense.
And that's precisely why it does make sense. The aluminum packaging industry is not a commodity business in the traditional sense. Our sources define its structure as a textbook oligopoly in the most critical geographies.
An oligopoly.
This is the ultimate economic moat protecting their profitability.
Okay, define that power of three dynamic for us.
In the Americas and Europe, the industry is just dominated by Ball, Crown Holdings, and Ardagh Metal Packaging. Together, they control a staggering 75 to 80% of the entire supply volume.
Wow, 75 to 80%.
That concentration is the key reason why they can maintain structural profitability.
And that consolidation exists because the barriers to entry are just immense. It's not just the cost, right? It's the lead time and the integration required.
The cost is formidable. To build a modern, high-speed can manufacturing plant, you're looking at hundreds of millions of dollars in capital expenditure.
It's hundreds of millions.
And it's not a quick process. Construction, installation, commissioning. You're talking a minimum of 18 to 24 months of lead time, and that's not even counting the environmental and regulatory approvals.
So you can't just decide to jump into the market overnight.
Not a chance. Plus, the product itself is high volume and low margin per unit, but it requires perfect logistics.
Right.
These companies aren't just selling a piece of aluminum, they are selling certainty of supply, quality control, and deeply integrated logistical management. They sign these high volume, logistically complex, multi-year toll manufacturing contracts.
And they integrate their operations directly with the giants.
Directly with Coca-Cola, PepsiCo, Anheuser-Busch InBev. The switching costs for a major beverage brand are prohibitively high, which just further solidifies the oligopoly.
Because the competition is rational within this structure, analysts note they don't fight a price war over the core product.
No, they don't.
Competition is based on scale, reliability, innovation like developing specialty can sizes or unique shapes. But the most critical factor insulating their profitability is the use of pass-through contracts. Let's spend some real time on this because this is the financial bedrock of the whole thing.
This clause is the single greatest piece of financial engineering in the packaging industry. It is a universal feature of their major customer contracts that allows the manufacturers to pass 100% of the raw material costs, specifically the cost of aluminum, directly to the customer.
Okay, let's use an analogy to make that really clear for the listener.
Think of Ball as a general contractor building a house. They charge you a fixed fee for their labor, their tools, their expertise. That's their conversion cost plus their margin.
Okay.
They then simply hand you the invoice for the drywall, the lumber, the wiring, in this case, the aluminum. If the price of aluminum doubles tomorrow, Ball's total revenue might jump because the total invoice is higher.
But their actual profit, their margin, is protected.
Their dollar-for-dollar profit margin remains completely protected. It's a perfect hedge.
That protection sounds incredible. I mean, it insulates them from the extreme volatility that sinks other industrial commodity-adjacent sectors.
It is absolutely fundamental. Their profitability is driven entirely by what they call value-added revenue, which is the revenue generated from the conversion process and that fixed margin they charge.
So they aren't taking a commodity price risk.
Zero. And that allows the market to view them as a high-quality, stable industrial rather than a cyclical materials company. This stability is key to their premium valuation.
Okay, so they have a stable, consolidated structure. Now let's talk about the massive tailwind that makes this pure play bet so valuable, the substrate shift. Why is aluminum winning the sustainability race against plastic, PET, and glass?
It comes down to recycling economics, and aluminum is the unequivocal winner. The key term here is infinitely recyclable.
Infinitely.
An aluminum can be melted down and be back on the shelf as a new can in as little as 60 days. It maintains its quality perfectly through every single cycle.
And the economics of that recycling loop are what truly differentiate it. It's not just that it can be recycled.
Exactly. The scrap value of aluminum is inherently high. That economic value is high enough to actually subsidize the recycling infrastructure required to collect and process it globally. It's a closed-loop system that basically pays for itself.
Contrast that with the peat problem with plastic.
The plastic recycling chain is, frankly, broken in most places. Recycling peat is often net negative in cost, requiring massive subsidies and consumer taxes to operate. But the critical failure is material degradation.
It's not a closed loop.
Not at all. Plastic is rarely recycled back into new food-grade or beverage-grade bottles. Instead, it is typically downcycled into lower-grade materials like textiles, carpet fibers, or park benches.
And once it's downcycled, it's out of the loop forever.
Forever. And consumers are increasingly aware of this, especially with the rising concern over microplastics and the massive brand risk associated with single-use plastics.
The carbon footprint comparison then really seals the deal for major corporations with aggressive ESG targets.
It does. While producing virgin aluminum is incredibly energy intensive, the fact that recycled aluminum requires 95% less energy is the game changer.
95%.
As global recycling rates increase, pushed by regulation and consumer behavior, the total carbon footprint of the average can just drops dramatically. It becomes the most carbon-efficient packaging substrate available for beverages.
Which makes it the default choice for new product launches.
It's the default choice for functional waters, hard seltzers, wine, canned cocktails, all the growth categories.
Now let's look at the regulatory environment, especially in Europe, because that seems to be the biggest accelerator, turning these sustainability aspirations into mandated demand.
Regulation isn't just compliance for Ball, it's a massive, quantifiable demand driver. The European Union's ambitious packaging and packaging waste regulation, or PPWR, is setting mandatory reuse and recycling targets that simply cannot be met without switching from plastics to a material like aluminum.
And a core part of that success is the deposit return scheme, or DRS.
These schemes, like the one that has been massively successful in Germany, are transformative. Consumers pay a small deposit on the can, which they get back only when they return it to a collection point.
A simple incentive.
It's a behavioral incentive that pushes can recycling rates to upwards of 90%. And crucially, this creates a vast, reliable supply of high-quality scrap aluminum, lowering the energy input costs further and truly closing the loop. This demand certainty is gold for a company like Ball.
That powerful regulatory tailwind makes their recent strategic M&A move, acquiring 80% of Benepac's European assets, make perfect sense.
It was a targeted, efficient move to capture immediate regulatory-driven volume growth. Those two modern plants in Belgium and Hungary filled critical geographic gaps.
Right where they need them.
Especially for servicing multinational customers who are switching from plastic to aluminum under imminent regulatory pressure. Ball didn't have to spend 2 years on greenfield construction. They bought capacity that was ready to run and immediately capture that regulatory windfall in the EME region.
That's the structural tailwind. Now let's circle back briefly to the geopolitical risks you mentioned earlier. Tariffs. While Ball is insulated from volatility, they are not insulated from trade wars that increase the cost of goods sold.
Right. The uncertainty surrounding the Section 232 tariffs on aluminum imports remains a persistent source of noise. These tariffs can raise the cost of primary aluminum by 10%, 25%, or even higher.
And as we established, they can pass that cost through to the customer, but it isn't instant.
There is a 30 to 90-day lag before those price adjustments hit the contract terms.
So what does that lag mean in practice?
It means that in periods of high volatility or sudden tariff hikes, Ball's working capital requirements increase, and their near-term margins can get compressed before the price adjustment finally catches up. It's a timing issue.
But the real non-trivial risk isn't the cost itself, which is recovered. It's the elasticity risk.
That is the greatest threat to the entire thesis. It's demand destruction caused by shelf price inflation.
Explain that.
If tariffs and commodity costs force a 12-pack of soda or beer to rise significantly, say, from $15 to $19, the budget-constrained consumer may just decide to trade down.
They'll buy something cheaper.
They might switch to cheaper, larger format plastic 2-liter bottles, which offer a lower price per ounce. If enough consumers pull back from packaged cans due to price sensitivity, that stalls Ball's hard-won volume recovery and undermines the entire secular thesis of the substrate shift.
And we've seen this happen before.
This consumer fragility was a significant factor in the soft North American volumes we saw back in 2023 and 2024. It's a very real risk.
We've established the strong market position and the insulated operational structure. Now, we must get into the financial mechanics that determine whether Ball is simply profitable or whether it's a true economic value creator. Let's start with the heart of their corporate culture, economic value added, or EVA.
This metric is fundamental to Ball. It defines their entire approach to capital allocation and management compensation, dating all the way back to 1992.
So this is deep in their DNA.
Deep. And EVA is the truest measure of economic profit because it accounts for the total cost of capital.
Okay, lay out the core formula for us again, but let's take our time with the implications.
The formula is pretty straightforward. EVA equals net operating profit after tax, or NOPAT, minus the capital charge. And that capital charge is simply the total invested capital multiplied by the weighted average cost of capital, or WACC.
So it's not enough to just make an accounting profit. You have to make a profit that exceeds the financial cost of the money, both debt and equity that you use to generate it.
Exactly. If you earn NOPAT of $100 million, but your capital charge is $110 million, you have actually destroyed $10 million in economic value.
Even though the books say you're profitable.
Even though the books show a profit. And this isn't some abstract metric locked away in the finance department. This is a deeply ingrained cultural philosophy. Plant managers, executives, business unit heads, they're all incentivized and compensated based on EVA growth.
How does that formula change a plant manager's day-to-day behavior?
It creates a powerful incentive against waste and hoarding. If a manager holds excess inventory, that inventory sits on the balance sheet as invested capital, and it generates a capital charge.
So it's costing them money.
It's directly impacting their bonus. If a manager lets an old machine sit idle or hangs onto an inefficient, outdated piece of real estate, that asset is still generating a capital charge but zero NOPAT.
So the culture forces them to be efficient.
The EVA culture forces managers to sell low-return assets, reduce unnecessary inventory, and optimize equipment utilization because doing so directly improves their compensation. It's ruthless capital management from the ground up.
So the aerospace sale wasn't just a strategic realignment, it was the ultimate EVA decision, wasn't it?
It was the perfect, massive case study in EVA thinking. They realized the valuation multiple offered by BAE Systems for the aerospace division was significantly higher than the internal EVA generation Ball could reasonably achieve by keeping it.
So they sold high.
They sold the asset high and then reinvested the proceeds into something that has a much lower invested capital base share buybacks, thereby maximizing EVA per share. It showed management was willing to make painful sacrifices to optimize the balance sheet.
That cultural alignment is powerful. But despite this discipline, let's address the massive financial red flag our sources identified: the ROIC versus WACC conundrum. This is the primary foundational challenge facing the new CEO, Ron Lewis, right now.
This is the critical disconnect that analysts are all focused on. As of late 2025, Ball's trailing 12-month return on invested capital, or ROAs, is hovering around 7.12%.
Okay, so that's the profitability generated by their assets.
Right. But their estimated weighted average cost of capital, or WACC, what it costs them to fund those assets, sits significantly higher, around 9.05%.
That is a negative spread of nearly 200 basis points.
Yeah.
For a company positioned as a high-quality compounder, this technically suggests that the existing asset base is destroying economic value. How do we reconcile this destruction with the strong market tailwinds they possess? Analysts argue this is largely a denominator problem that stems from history, not from current operations.
A denominator problem. Break that down.
The ROIC formula is NOPAT divided by invested capital. The denominator invested capital was massively and sort of permanently inflated by historical acquisition, goodwill, and growth capital expenditures.
And the main culprit here is the ghost of the 2016 Rexam acquisition.
Absolutely. That was a massive $6.1 billion deal. And while the operational synergies from Rexam were fully delivered, they increased scale, reduced competition, streamlined the network. The financial residue remains.
What's the residue?
A significant portion of that purchase price was recorded as goodwill on Ball's balance sheet.
Okay, explain why that goodwill is so sticky and how it permanently inflates the denominator. Goodwill represents the premium you paid over the fair market value of the tangible assets you acquired. Under standard accounting rules, that goodwill cannot simply be written down or amortized unless the asset completely fails a profitability test.
Which the packaging division is not doing.
Not even close. So the $6.1 billion acquisition permanently increased the base of invested capital, the denominator in our ROIC equation, without a proportional increase in tangible operating assets that the new CEO, Lewis, can sweat.
So it's an asset that doesn't turn out cans, but it still incurs an enormous capital charge.
That's it. It's a ghost asset. So Lewis is essentially fighting a historical debt burden that is making the company look inefficient on paper, regardless of how well they're actually running the plants today.
So how does he close that 200 basis point gap and make the business truly EVA positive again?
It requires a two-pronged, hyper-disciplined strategy. First, numerator growth. This involves relentless cost-cutting, driving utilization rates higher, and capturing higher margin volume, like from energy drinks, to boost that NOPAT number.
And the second prong.
Second, and equally important, is denominator shrinkage. This is pure capital discipline. They are pursuing aggressive share buybacks, which reduce the equity component of invested capital, and strategic closures of inefficient older plants.
The plant closures, Kent, Washington, and St. Paul, Minnesota, were a perfect example of denominator shrinkage, right?
Exactly. Those plants were dragging down the overall efficiency metrics. By shutting them down, Lewis reduced the total invested capital base, the denominator, while simultaneously forcing higher utilization rates in the remaining, more modern facilities.
Which increases the NOPAT generated per dollar of remaining capital.
Precisely. They are focusing on making more money on fewer, better-run assets to chip away at that 200 BP's deficit.
But to execute aggressive buybacks, pay down debt, and make strategic bolt-on M&A, they need superior cash flow and a fortress-like balance sheet.
And that is their greatest advantage. Ball is a genuine cash conversion machine. They target free cash flow conversion of 100% of comparable net earnings, which is a sign of a very high-quality business model.
And what are the forecasts for that?
Management has guided for free cash flow between $900 million and $1 billion in 2025, growing to $1.2 billion in 2026. This consistent cash generation is what fuels the entire buyback strategy.
And that liquidity advantage is stark when you contrast it with the major competitors in the oligopoly.
It provides the counter leverage. After the divestiture, Ball's net leverage ended Q3 2025 at a very conservative 2.2 times. Now, contrast that with a major competitor like Ardagh Metal Packaging.
What's their situation?
They're currently operating with leverage north of 5 times. Ardagh is spending all its free cash flow on mandatory debt service, focused purely on survival.
While
Ball, conversely, is financially free to be opportunistic, aggressively buying back stock, investing in efficiency upgrades, and executing strategic bolt-on M&A like that Benepack deal. Their balance sheet is the source of their competitive edge.
Let's break down where the actual volume growth is coming from globally, starting with North America, which still accounts for nearly half of their total revenue. The story here seems to be one of stabilization after a pretty turbulent few years.
That's right. North America, sitting at about 48% of total revenue, has been grappling with persistent cyclical headwinds. We saw soft domestic beer volumes, driven partly by that persistent inflation squeezing the consumer,
Right.
and the lingering, very specific volume impact from the Bud Light controversy that ran through 2023 and 2024. Those cyclical troughs now appear to be fading as pricing stabilizes.
But the sources highlight a high-growth, high-margin powerhouse category that is completely offsetting that softness: energy drinks.
This is a major structural benefit for Ball. The high-margin energy drink category, Monster, Red Bull, and dozens of smaller functional brands, is growing mid-single digits consistently.
And Ball is the key supplier.
They are the dominant supplier in this market, which relies heavily on specialty can sizes and unique printing, allowing them to charge a premium over your standard 12-ounce beer cans. This volume isn't dependent on macro trends in beer, it's secular growth.
Driven by new consumer habits and functional beverages.
Correct. And we see the new operational discipline being applied here too. The decision to close the older, inefficient plants in Kent and St. Paul was a market correction.
It was surgical capacity removal designed to increase pricing power and margin.
That's exactly what it was. Those two closures removed approximately 4 billion units of older capacity from the North American network. This tightened the regional supply-demand balance considerably,
allowing Ball to run its remaining, more modern facilities at higher margin-accretive utilization rates.
It's the Lewis mandate in action. Fewer assets, higher efficiency, higher return.
Okay, moving across the Atlantic, EMA, that's Europe, Middle East, and Africa, is clearly the strategic growth engine right now, posting an exceptional 14.8% jump in segment operating earnings in Q3 2025.
This is where that structural tailwind meets mandatory regulation. European customers are actively paying a sustainability premium because they have no choice but to meet the EU PPWR targets. The demand for aluminum is immediate and inelastic.
So the Benepack acquisition was key.
The acquisition of the two Benepack plants in Belgium and Hungary was absolutely critical for capturing that volume and servicing multinationals who are migrating from plastic to aluminum very, very rapidly.
And that makes EMEA a stable, high-growth engine. And then there's South America, which the analysts call the high beta play.
Right. South America, about 17% of revenue, offers immense growth potential, but it carries significant volatility. The region is prone to extreme economic fluctuations, like the stagnation we saw in 2023-2024.
And there are other challenges.
You also have the ongoing challenge of hyperinflation in places like Argentina, which forces the company into constant, very complex price adjustments just to maintain currency parity.
But the core market is fundamentally strong.
It is. Brazil, in particular, is a robust and mature market where cans are dominant. Over 50% of the beverage mix for beer is already in cans, which is a higher saturation rate than even the U.S. So while the volatility is high, the underlying growth potential as those markets mature is also immense.
Finally, let's revisit the Ball Aluminum Cup reset one more time because it illustrates the new discipline, not just in the P&L, but in their future diversification strategy.
The aluminum cup was a bold vision, replaced the plastic cup at concerts and sporting events, but it was losing about $40 million annually, and Ball's traditional B2B sales force just wasn't built for marketing a direct-to-consumer or event-focused product.
So the solution was the joint venture with Aina.ai.
It was a tactical, low-cost risk management strategy.
How so?
They stopped the bleeding on the P&L immediately by transferring the operational risk and the marketing challenge to Aina.ai while retaining 49% of the equity.
So they maintain upside optionality without the downside drag.
Precisely. It's the perfect illustration of Lewis's philosophy. Focus capital only where the return is proven. And it also enables them to focus on other small strategic diversifications, like their late 2024 acquisition of Alukin.
What did that do?
That moved them into the high-margin personal care packaging market aerosols and extruded aluminum bottles, which is also just starting its own plastic to aluminum transition phase. It's another small, smart bet.
We have laid out a very strong case for Ball as a superior-focused industrial compounder benefiting from structural tailwinds. But we need a balanced perspective. What are the non-trivial risks that could undermine this whole investment thesis beyond that internal battle against the Wrexham goodwill drag?
Let's start with the operational input cost risks again. The uncertainty surrounding those Section 232 tariffs on aluminum imports remains significant. If these tariffs are suddenly escalated, it immediately raises the cost of goods sold.
And while they can pass the cost on, there's that sticky 30 to 90-day lag.
And as we established, the lag isn't the real problem. The risk is what the consumer does when that cost finally reaches the shelf.
That's the real threat, elasticity risk.
Exactly. When the cost of a 12-pack of soda or beer, pushed by tariffs and inflation, starts approaching $18 or $19, the risk of consumer abandonment becomes very high.
And they trade down.
If budget-conscious buyers decide en masse to trade down to cheaper, high-volume plastic options, which might cost half as much on a per-ounce basis, Ball's volume recovery stalls, and the entire secular thesis slows down dramatically. It's the constant battle between sustainability ideals and consumer wallet limitations.
Beyond commodity costs, they face risks associated with customer concentration. They rely on the immense bargaining power of giants like Anheuser-Busch, InBev, Coca-Cola, and PepsiCo.
Customer concentration gives these titans enormous leverage during contract renewals, and that always poses a threat of margin compression.
But there's a mitigation factor.
The oligopoly structure acts as Ball's primary mitigation factor. Coke or Pepsi need tens of billions of cans annually, and they have very few alternatives for high-volume, logistically complex, quality-assured supply.
So it's an interdependence.
This interdependence provides Ball with crucial counter-leverage during negotiations. They aren't selling a common bolt. They are selling a vital part of the global beverage infrastructure.
And then there's the regulatory risk. Right now, European legislation is a powerful tailwind. But if that momentum slows, Ball's growth thesis slows right down with it.
Ball's premium valuation is heavily predicated on the continuation and acceleration of that plastic to aluminum shift. Any relaxation of plastic bans in Europe or major bureaucratic delays in implementing critical deposit return schemes across large member states would slow that momentum.
So regulatory failure is a non-trivial risk.
It's a risk that directly impacts their ability to capture that high-margin growth volume.
Finally, let's talk about a fascinating low-probability but high-impact long-term tail risk that has crept into investment discussions recently, the Ozempic effect.
This is the risk associated with the widespread adoption of GLP-1 weight loss drugs. These drugs drastically reduce appetite, and, critically, they reduce the craving for high-calorie, sugary foods and beverages.
So the theory is people will drink less soda and beer.
The theory is that if widespread global adoption significantly reduces aggregate calorie consumption, the total addressable market for traditional sugary sodas and beer, both core can segments, could theoretically shrink over the long term.
That sounds like a fundamental challenge to the entire beverage industry. But is there a counterargument specific to Ball's product mix?
There is a very strong counterargument based on the current internal market shift. While aggregate consumption of full sugar products might decline, the demand for healthier beverages is soaring.
So it's about what people are switching to.
Exactly. The shift within the shrinking or stabilizing beverage market is overwhelmingly towards zero-sugar drinks, sparkling waters, functional energy drinks, and low ABV or non-alcoholic options.
And these are all products that rely almost exclusively on the aluminum can for packaging.
Pretty much. So the overall pie might shrink slightly, but the portion of the pie that uses aluminum packaging is set to grow significantly.
So the Ozempic effect might just accelerate the internal market shift that already favors the aluminum can.
It could, as consumers seek healthier, portion-controlled, and functionally packaged alternatives. It's a long-term risk that requires monitoring, but for now, the substrate shift benefit appears to offset the aggregate consumption risk.
This deep dive has shown how an industrial company transforms its value proposition by subtraction and by hyperfocus. Ball bet the entire future on the aluminum can by selling its crown jewel aerospace.
A huge bet.
And is now aggressively returning capital to shareholders via massive buybacks, forecasting $1.5 billion in the near term.
The resulting company is streamlined, it's focused, and it possesses a powerful economic moat. The key takeaways for you, the listener, are clear. Ball is highly insulated from raw material volatility due to its oligopolistic pass-through contract structure, which protects margin dollars.
And crucially, the long-term, high-margin growth story is deeply reliant on the European regulatory environment, driving that immediate and inelastic plastic-to-aluminum substrate shift.
Furthermore, the new management team under Ron Lewis is explicitly incentivized, through that EVA metric we discussed, to address the core financial challenge: the negative spread between their return on invested capital and their weighted average cost of capital.
They are focused on operational excellence to repair this fundamental profitability metric.
Absolutely.
Ball currently trades at a premium around 20 times forward earnings, which seems justified by its superior balance sheet, its high cash conversion, and that powerful secular growth tailwind. But this premium requires Lewis's team to successfully execute the efficiency strategy and close that 200 basis point capital efficiency gap.
And that brings us to the final provocative thought for you to mull over as you digest this analysis. The entire discussion about the ROIC versus WACC spread is fascinating because it presents a paradox.
What's the paradox?
The company is currently destroying economic value on paper, yet its core assets are absolutely essential to the global beverage infrastructure. You are left to ponder this. Can a pure-play, high-quality industrial compounder truly escape the drag of a massive historical acquisition, specifically the structural goodwill from that $6.1 billion Rexam deal, solely through operational excellence and aggressive capital efficiency measures?
Is aggressive share buyback, reducing the denominator, enough to bridge that 200 basis point gap? Or will that historical capital burden forever prevent them from earning their true cost of capital?
That is the question.
That internal battle against history will define Ball's valuation for the next decade. We encourage you to keep diving into the metrics behind that overhaul. Until next time.
Until next time.